Silver crossed $120 in January. Then it didn't. Within weeks, not months, weeks, it was in the low 70s. A $50 drop. Roughly 40% of its value gone. Not because of a supply glut, not because industrial demand collapsed. Because one name got floated for Federal Reserve Chair. Kevin Warsh. A single political appointment rewrote the price. Then it recovered. It's sitting near $84 today. So here's the question that actually matters. The one worth sitting with before we get into any of the data. If the bull case was real at $120, what is $84? Is this a wounded bull catching its breath? Or is the rally over and we're just watching the slow unwind? Because here's what didn't happen when Warsh's name appeared. The supply deficit didn't close. The COMEX inventory didn't refill. Industrial demand didn't evaporate. The fundamentals didn't move. The price did. That gap is what this is really about. Let's set aside the price for a moment and look at what's actually underneath it. The Silver Institute tracks global supply and demand with more granularity than most financial media bothers to read. What their data shows for 2026 is a structural deficit of approximately 67 million ounces. That's the gap between how much silver the world produces and how much it consumes. And it isn't new. This is the 6th consecutive year that gap has existed. 6 years. Not a blip. Not a post-pandemic distortion that's resolving. A structural imbalance that has been widening while most investors were focused on the gold price. That deficit has to come from somewhere. It comes from above-ground stockpiles, and those stockpiles are draining. Which brings us to COMEX, the exchange where silver futures are traded and, in theory, settled with physical metal. Registered inventories, the silver that's actually available for delivery, sit at roughly 81 million ounces.
That sounds like a lot until you put it next to annual demand of 1.12 billion ounces and realize it represents less than a month of global consumption. Every delivery month, the gap between paper commitments and physical availability gets tested. March is one of those months. The stress is building, and it's not hypothetical. It shows up in the forward curve, in the backwardation that signals the market is paying a premium for metal now versus later. Then there's the supply side of the equation. Global mine output is growing at about 1.5% annually. Mexico, Peru, China, they're producing, but not fast enough. Investment demand is up 20% year over year. Chinese and Indian retail buyers are accumulating physical bars and coins at a pace that's absorbing supply that would otherwise buffer the deficit. ETF inflows are adding another layer of demand on top of that. The math simply doesn't close. Here's a question worth sitting with. When you think about silver, what mental model are you using? Most people who follow precious metals think of it primarily as a monetary hedge, a dollar alternative, an inflation play, something you hold when you don't trust central banks. That framing isn't wrong, but it's incomplete in a way that matters, because it misses the fact that silver is simultaneously an industrial commodity running a 6-year structural deficit, with critically low exchange inventories and accelerating physical demand from retail investors in 2 of the world's largest economies. That's a different animal than a monetary hedge. And the distinction shapes everything about how you should think about what comes next, especially when you look at where the bulk of that industrial demand is actually coming from. There's a bear argument on silver's industrial demand that circulates constantly, and it's not wrong. It's just incomplete in a way that leads people to the wrong conclusion. Here's the argument. Solar manufacturers are reducing the silver content per panel. Thrifting, they call it. And it's real. Copper substitution is happening at the margin, too. So if silver's industrial demand is partly a solar story, and solar is using less silver per unit, doesn't that erode the foundation? It would, if volume were flat. It isn't. Global solar installation is still expanding. EV production is still scaling.
Efficiency gains per unit don't offset aggregate demand growth when the number of units keeps climbing. The math runs in the wrong direction for the bear case. Total industrial demand sits at 650 million ounces. Even at a conservative 3.4% compound annual growth rate through 2031, that number moves in one direction. Mine supply, growing at 1.5% annually, cannot keep pace. The thrifting argument is real. It just doesn't close the gap. But here's the part that most demand models are getting wrong, and CPM Group flagged this explicitly in their March 2026 interviews. AI data center infrastructure and military electronics were systematically undermodeled, not slightly, significantly. Silver's conductivity is not easily substituted in high-performance computing environments. The thermal and electrical requirements are too demanding. The build-out of AI semiconductor fabrication and high-performance computing infrastructure represents a demand vector that wasn't in the consensus numbers at the scale it should have been. That's not a prediction about the future. It's a correction of the existing record. So step back and ask yourself something directly. If you came into this video thinking of silver primarily as an inflation hedge or a dollar alternative, does that frame still hold? Because what the data describes is not a monetary metal with some industrial exposure. It's a critical industrial commodity, running a 6-year structural deficit with tightening exchange inventories, accelerating physical demand from retail buyers in China and India, and 2 undercounted demand vectors that are still being absorbed into consensus models. That also carries monetary optionality. That reframe isn't semantic. It changes how you size a position, how long you hold it, and what you're actually watching when the price moves. The floor, then, is firmer than most people appreciate. But a floor doesn't tell you anything about a ceiling. For that, you need a different instrument entirely. There's a cleaner way to think about silver's upside. One that doesn't require a macro call or a conviction about inflation. It just requires a ratio and a calculator. The gold to silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, that number is approximately 61. Gold is trading near $5,150 per ounce. So silver, at $84, is priced at roughly 1/61st of gold. The question the ratio asks is simple. Is that relationship historically normal? And the answer is no. It isn't close to normal. Over the last century, the ratio has averaged somewhere between 45-1 and 55-1. It spiked violently during the COVID dislocation in 2020, briefly touching 120-1, and has been compressing since, with interruptions, in a direction that most serious commodity analysts don't dispute. The argument isn't about whether the ratio reverts. It's about when. Now run the arithmetic. If the ratio moves to 50-1 and gold stays exactly where it is today, silver reaches approximately $103. That's not a bull case built on enthusiasm. That's a conditional output from a single variable moving toward its historical mean. No new demand catalyst required. No Fed pivot required. Just reversion. Bank of America's Michael Widmer has modeled the scenario where gold continues its own bull run while the ratio compresses simultaneously. Under those conditions, the outputs extend well beyond $120, and in more aggressive assumptions, considerably further. The point isn't to anchor to those numbers. The point is to understand the structure. 2 variables, both moving in silver's favor, produce non-linear upside. What makes this argument credible, genuinely credible, not just compelling, is the honesty about what it doesn't tell you. The direction of ratio compression is not seriously contested. The timing is entirely unresolved. Anyone claiming to know when the ratio reaches 50 is selling something. What the ratio gives you is a framework for sizing the opportunity, not a schedule for collecting it. That distinction matters when the macro environment is capable of interrupting the move without breaking the thesis. Which brings us to exactly what that would look like. Every strong thesis has a breaking point. Knowing yours in advance is what separates a position from a bet. 3 risks deserve honest treatment here.
not as disclaimers, but as live variables worth monitoring. The first is the dollar. When the DXY rallies hard, above 108 toward 110, it caps silver regardless of what the fundamentals say. February demonstrated this cleanly. Middle East tensions spiked oil, safe haven flows moved into the dollar, and silver gave back ground even as the deficit data went unchanged. The metal and the currency move in opposition, and when macro fear dominates, the currency wins in the short term. That's not a flaw in the thesis. It's a feature of the asset class you need to price in. The second is the Fed. Kevin Warsh replacing Powell is not a neutral substitution. Warsh is structurally more hawkish, and if core CPI stays sticky in the 2.5 to 3% range, the conditions for a dovish pivot simply don't materialize. Fewer than one cut in 2026 keeps real rates elevated. Elevated real rates weaken the monetary bid for silver, not the industrial bid, but the store of value premium that's embedded in the current price. That premium is real. It can compress. The third is solar demand destruction. Silver paste costs have risen roughly 2.5 times in 6 months. At some threshold, that price pressure doesn't just accelerate thrifting. It accelerates the technological transition away from silver-based cell architecture entirely. If that shift happens faster than current models assume, the industrial demand floor drops with it. None of these risks, individually or together, produce a structural reversal. What they produce is a pullback, likely towards $78 to $80, where the 200-day moving average cluster sits. That level is meaningful. Below $80, the thesis doesn't collapse, but it requires reassessment. Above it, the bull case remains structurally intact. Here's the question worth sitting with before the next chapter. Of those three risks, the dollar, the Fed, or solar demand destruction, which one do you find most credible? Because your honest answer to that question should directly determine how aggressively you size any exposure. Not the bull case, not the ratio math. Your personal read on which risk is most likely to materialize. That's what position sizing is actually for. With the risks mapped, the question becomes practical. Given everything, the deficit, the ratio, the macro headwinds, what does a rational framework for thinking about this trade actually look like? The numbers matter less than the habit they represent. Here's the framework. 3 scenarios, each with a condition that triggers it. Not a prediction, but a map. The base case, roughly 70% probability. Silver consolidates in the $78 to $92 range through mid-March, then moves toward $95 to $105 by May as COMEX delivery stress tightens and industrial demand continues to assert itself. No dramatic catalyst required. Just the structural pressure already in place doing what structural pressure does. Slowly, then faster. The bull case, roughly 20%. A dovish signal from the Fed, or a geopolitical escalation that drives safe haven buying into metals rather than dollars, compresses the gold-silver ratio faster than the base case assumes. Silver reaches $120 to $135 before end of Q2. This scenario doesn't require everything to go right. It requires one significant macro variable to shift direction. The bear case, roughly 10%. A major dollar rally, DXY pushing hard through 108, or an accelerated demand shock in solar forces silver back to $70 to $75. At that level, the near-term thesis is invalidated. Not permanently, but the setup resets and the entry conditions change. 4 events function as thesis checkpoints between now and May. The Fed's March 18th to 19th meeting, the March 12th CPI print, COMEX delivery notices through the end of the month, and any material Middle East headline. Each one has the potential to move silver's price and, more importantly, to confirm or challenge the scenario you're operating in. Watch them as data, not as noise. The positioning logic that follows from this is straightforward. Core long exposure, physical metal, option structures, make sense across the base and bull scenarios, which together represent 90% of the probability space.
A stop below $80 on tactical positions contains the bear case damage before it compounds. But the specific numbers here are not the point. The point is the structure behind them. Map your outcomes to conditions, assign rough probabilities, identify the events that will tell you which scenario is unfolding, and decide in advance what you'll do if the price tells you you're wrong. That habit, practiced consistently, is worth more than any price target. Most assets live in one world. They're a currency play, or a commodity, or a geopolitical hedge. Silver right now is all three simultaneously, and that convergence is genuinely rare. It's why a single Fed appointment can move the price 40%, while a 6-year supply deficit holds the floor. It's why the analysis requires more than one frame. The asset itself refuses to sit still in any single category. That's the setup. Make of it what you will. Nothing in this video is financial advice. The analysis here is for educational purposes only. Your research, your decisions, your responsibility.